Yesterday, the US Treasury announced something unexpected. Gold jumped more than 3%. Here's the connection. The 30-year US Treasury yield just hit 5.33%, its highest level since 2007. Investors were worried about rising government debt, huge capital needs, and persistent inflation pressure. And then the Treasury announced it would at least double its long-term bond buybacks from $2 billion to at least $4 billion per operation starting September. The reaction was immediate. The 30-year yield fell nearly 10 basis points. The dollar fell about 0.8% and gold jumped above $4,500 an ounce. But why does a treasury buyback matter for gold? Because gold doesn't pay interest. When bond yields fall, the opportunity cost of holding gold falls too. That is why gold becomes relatively more attractive. And there is a second effect. A weaker dollar makes dollar-priced gold cheaper for investors using other currencies, potentially supporting the demand. That is why this wasn't really about $2 billion more in buybacks. The bigger signal was that the Treasury is willing to use its buyback program more aggressively when the long end of the bond markets come under pressure. And that's the part gold investors are watching carefully, not just what the Treasury bought today, but what it might be willing to do next. I'll break down what this could mean for gold in the Capital Compass Edition 15 coming this Sunday. The link is in bio. And make sure to save this reel and follow me for more such future updates.